Hello, everyone. This is Jelena Ogilvy with Principal Wealth Partners. Welcome to our 5-minute market update, where we will discuss three things: the return of the stock market so far this year, some opportunities that we have found, and how investors have reacted through the pandemic. To say that this year has been unparalleled to any other year would be an understatement, and the stock market is certainly part of this story. As of the third quarter, the S&P is up 15%, which would appear to be a solid, strong year of returns. However, let's review these 3 quarters. After the S&P reached an all-time high on February 19th, we entered quarantine in March, shut down 95% of our economy, and experienced a decline of 34% within 1 month. April followed with the best monthly return in over 30 years on announcement of fiscal and monetary stimulus, coupled with expectations of the economy reopening. In August, we surpassed the all-time highs of February, with further volatility on the downside in September. With the equity markets back at all-time highs, there is concern on how to invest in an asset class that appears to have run ahead of itself this year. Despite this, we continue to find some opportunities. As discussed earlier this year, when you look under the hood of the S&P, not all 500 companies have performed the same. It appears that our emotional biases in the pandemic have created the loved versus the hated stocks. In fact, the variance of return between the best and worst performing sectors for the year is a staggering 80%. At the top of the page, you will see technology up almost 40% versus the bottom of the page where energy is down over 40%. This opportunity is not only by sector, but also from asset classes that may act like equities. One such example is convertible bonds. They are a fixed income corporate debt that can convert into equity shares. What that means is that they share qualities of both traditional bonds and stocks. Historically, convertible bonds will give you an equity-like appreciation while providing better downside protection than traditional equities. During the sell-off of September, convertibles were down 5.5% relative to the S&P, which fell down 9.5%. In fact, as you can see here, convertibles have not only done well this year with equity-like return, but have actually far surpassed the S&P. As of the end of the September, convertibles on the right are up 18.5% versus the S&P on the left-hand side up about 1.6%. Convertibles are more in line with the NASDAQ index in the middle, just over 19%. This is one of several asset classes that we have been able to rely on this year for our clients to diversify some of their equity return. This year has been another reminder as to how emotional we can be, and to our own detriment most times. Investors fled to safe haven investments, and one being cash. As you can see here, cash levels surpassed the peak levels of the global financial crisis. In fact, the personal savings rate soared from 8 to 33%, all of this recurring while money market rates plunged. As an example, the Vanguard Money Market Fund is quoting a yield of 0.01%. The yields on these money market funds are lower than the fees to actually manage the funds themselves. This rush to cash does not appear to be thoughtful decisions of individuals based on their long-term financial needs. We must also remind ourselves of the importance of sticking to a plan. This is a famous study by Dalbar. It highlights the performance of the broad asset classes over the last 20 years. And notice to the far right, the orange bar, which is the worst performing. This is the average investor with less than a 2% return over the last 20 years. We live in an age of technology today where information is constantly at our fingertips. You would think that the return of the average investor over time would improve with this information. Yet the performance of the average investor really hasn't changed over time, according to Dalbar. They continue to underperform every asset class due to the emotions which affect their investment decisions. It is crucial in environments like this, we remind ourselves of why we have a financial plan and to keep these emotions from driving our investment decisions. In summary, the market this year from a 10,000-foot view appears normal, but it certainly has not been. Each quarter has introduced us to new and unique circumstances that has created investors to react on their emotions. It is proven historically these emotions are detrimental to an investor's portfolio. Our job at Principal Wealth Partners is to emotionally hold your hand during these times, educate you on how to not react to these emotions, and to find opportunities such as convertibles for you when we find these dislocations. As always, please reach out if you have any questions, and thanks for listening.